Businesses can be funded through debt financing. This is normal practice as it helps the business to grow. However, over time, rising debt level could have certain damaging consequences. Okay, but what exactly does rising debt level mean for a business? Well, there are several implications. There is pressure on the company's cash flow to pay interest. There could be possible reduction on companies' profits. Ultimately, the shareholders suffer through lower dividends. And this could send the wrong signals to the market, especially if the company is quoted on the stock exchange. Examples are Carillion in the UK and Evergrande in China, which had huge debt level. But how can we manage rising debt level? Number one, we can renegotiate or refinance our loan arrangement. We could increase the streams of revenue for the business. And we could apply some intelligent reduction in costs. Example, reduce the rental space, maybe for your office, and also having better management of inventory level. My name is Shaktee Ramtohul, and I'm a lecturer in accounting and finance.